This is about to happen. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, an industry insider and billionaire investor is now making a dire prediction that the U.S. economy is going to spiral into a hard landing, and this is going to start in a matter of weeks. We're going to take a look at what his prediction is, what economic indicators he's looking at, and why we think he's actually underestimating just how bad the next crisis will be. But before we get to that, we're seeing signs that inflation is cooling off. Does this mean that the Fed is now one and done and facing a pause in June? We're going to make the case of why the Fed is behind the curve, and they're going to be cutting rates into a rapidly slowing economy. And we've got update on the debt ceiling. We're going to take a look at who we think the winners and losers are, because is the U.S. government about to face its first ever default and send the U.S. economy into a deep depression? Well, we'll take a look at what we think on that. Now let's head over to Bloomberg, where we picked today's story up with a headline: U.S. inflation shows sign of moderating, giving the Fed room to pause. Now, again, this is all about the Fed. Now, if we go back to the pandemic, this really didn't have much to do with the Fed, because what happened during the pandemic, we shut down the global economy, and it's particularly here in the U.S., what did we do? A massive amount of fiscal and monetary stimulus. And it was a key part is a fiscal stimulus, because what did that do to all of the shelves around the country, the warehouses? Well, it just evaporated the inventory and led, of course, to what we know now is inflation. And this is being turned over to the Fed to control. But if you think about it, the moment we pulled away all of that fiscal stimulus, we were starting to sow the seeds for a slowdown. Now, it doesn't mean that it was going to be a rapid decline, because we keep hearing from policymakers that inflation isn't falling fast enough. Well, the real problem isn't that inflation isn't falling fast enough. As many of you know, you made it said in the comments that it's your wages that aren't keeping up with prices. So that's the problem we have here, is that the Fed now continues to believe that they have some mythical power of the economy, that they can just pull back the reins by raising interest rates. And at some point, they're going to get to just the right spot, and they're going to know that, hey, we need to stop now, and that economic growth engine is just going to slow down and smooth out, and everything's going to be fine. We know throughout history that's not how this works at all, because what we really want is wages to be driving inflation. Instead, we had prices leading inflation higher, and we've known from the Fed, they've been making it very clear they want to see more people out of work, because that will contain inflation. Well, it's not going to just contain inflation, it's going to create a massive crisis. The consumer price index rose by below forecast 4.9%, again putting this well over the Fed's 2% target, the first sub 5% reading in 2 years. But a narrower price measure often cited by Fed officials tracking services that had boomed as the pandemic faded registered the smallest monthly increase since mid-2022 as airlines and hotel costs declined. So what we're seeing is kind of that lag. Remember, we talk about this when we look at those PMIs, those purchasing manager indexes. We see the manufacturing sector tends to lead the services sector. What did we see following the pandemic? We saw the services sector open slower, open later, and people head to that. But what's troubling me about this report is the notion that airfare and hotel costs, are starting to decline a little bit as we head into the summer months, which tells me that people's ability to have money on discretionary spending, to go on vacation, maybe they don't have as much money now. And when you look at the economy, the summer months are so critical for so many businesses, because they make a lion's share of their money during that period to get through the lean months of the winter. So if we're seeing a marked slowdown now, it tells you that something bad is not only coming, but potentially weeks away, as we'll look at in our next story here in a bit. But what's keeping inflation up is shelter costs, which are the biggest services component and make up about 1/3 of the overall CPI index. That rose 0.4% last month, the smallest in over a year. So what we're notably seeing here is that even though rent and shelter costs are rising, we've talked about how this is a very lagging indicator, but the pace of those increases is slowing. And we'll look at some charts here in a moment, and we'll see that once this turns over and heads down, what we should experience then is a a sharp decline in the broad CPI index. That will put the Fed on an immediate panic mode, as now they're faced to cut rates into a slowing economy, which is not exactly what you want to see happening. Because of the way the housing market metrics are calculated, there's a significant, and it's an understatement, as I just mentioned, lag between the real-time price changes and the government statistics, meaning it's possible that the CPI index is artificially high, as other metrics suggest these gauges will soon turn over, but economists are split, and of course they would be, on the exact timing, because there's no way to predict the exact timing of this. But now let's take a look at this chart so you can see the shelter and rent inflation are just off the charts from what we've seen in decades, and this is causing a problem. This is keeping that consumer price index up, because remember, the shelter component is about 30%. It's a huge factor here, and when we start to look at this next chart, which is the consumer price index, that's in blue, against the rent of primary residence of the U.S. city average in red, what do we tend to see is the blue line, the CPI starts disinflation, it heads down, and then with a lag, you start to see the shelter kind of peak, roll over, and come down, and then next thing you know, there's an acceleration of the CPI to the downside. We kind of see that here in the early 80s. We see that here in the early 90s. We see that kind of in the mid 2000s, as again that rolls over and keeps inflation down for a bit. We see that in the global financial crisis, see that in the pandemic, and we haven't seen that yet because it hasn't rolled over. But when it does, as we're going to look at the report here in the moment, we're seeing a lot of disinflation in the report, and we're seeing some outright deflation, which I said was going to happen. So now it's just a matter of some of these bigger components, this rent and shelter component rolling over. When that does, there's nothing keeping the CPI up, as you're about to see. So here we can see 4.9% all items, but notably, let's start with the headline. What was really driving it was food away from home and food at home running at 7% and 8.6%. But notably, what are we seeing at food at home? We're seeing some deflation on the monthly prints, telling us that the year-over-year rate of change will slowly turn over and head down. What are we starting to see? Food away from home at restaurants. We just got our first kind of print here that maybe this is starting to slow down and may turn the other direction. But look at the energy. You see this minus 5.1 with double-digit year-over-year comps on, of course, gasoline. And what do we know when we look at the gasoline charts? That here in mid-June or so, that's the peak of what we saw gasoline prices. We saw crude oil prices. So the deflationary comps of what we're going to see in these year-over-year rate of changes is going to be pretty steep. It's going to be putting downward pressure on the CPI here over the next couple months. But how about the core? When we strip out food and energy, there you can see shelter component running at 8.4, perhaps starting to see some early signs, as Bloomberg pointed out, that it's slowing down. How about transportation services? After a big run up, they had a deflationary print, so maybe it's trend change here. So notably, what we're seeing is just kind of some of these lagging effects of the CPI starting to work themselves out, but it's really energy is a key driver here, as we'll see on this next chart. And notably, U.S. regular all formulations gas price, you see this beautiful correlation with the consumer price index, well, except the kind of disconnect here that we saw during the kind of expansion out of the pandemic. We saw the year-over-year rate of change in gasoline stay rather high for quite a while. Now it's coming down, and perhaps some of that is back feeding into other components of the CPI that as it works out, we know the CPI is coming down, and if gas prices just hold their current year-over-year rate of change, well, that means we're going to be right on top of the Fed's target before the Fed even realizes it. And of course, we know that there's other factors here driving this. The yield curve has predicted that inflation is coming down. We can see now the yield curve shown in red, that 10-year minus 2-year that we love to look at. I've got it inverted with the inversion showing above the green line. So we can see this very steep inversion. This is going to be a factor in our next story here in a moment that is saying, look, the story about inflation, when you see these inversions, there can be a transitory increase in inflation after, but what happens is inflation is coming down in a big way, because in our story we did the other day, what did we talk about? Banks and credit creation. When banks are not out lending, and they're tightening lending standards because they're making virtually no money on loans, or when you see an inversion, they're potentially losing money on loans. So what they don't want to do is lend. They don't want to create money into the economy, and there's no way at that point you see inflation persist, as we've shown you in the charts. So everything here we're seeing says the broad economy, not the Fed, is really in charge here. But I made the case as we started the show that the Fed is going to chase the CPI lower and chase the economy down. And sure enough, what do we see on this chart here? Is we have the federal funds rate now in red against the CPI. And what do we note? That usually and almost always the Fed is cutting ahead of the CPI fall. And we see that here in the late 80s, early 90s. We see that in the early 2000s. We see that going into the global financial crisis. Even as oil drove inflation higher, the Fed was cutting. We saw that before the pandemic. But now, for some unknown reason, and maybe you have an opinion. I'd love to know. Do you think it's political? Do you think this time that Powell's up to something? Do you think they really believe in their data that they're going to get inflation down? Or is it a factor that inflation just went too high because of all the pandemic response? What do you think is going on here? But the case is really simple. At some point, as the yield curves have suggested, and mind you, we're seeing massive inversions, Eurodollar futures curve, treasury curves, everything saying when the Fed cuts, they're going to have a massive move to the downside, putting us in position where we expect to see that in June, they are likely to pause, if not potentially begin their cutting cycle. But today's CPI report may be not enough, and something else that may not actually help drive the Fed to cut. Well, of course, we see a big draw in crude oil inventories. So what do we know here? Distillate's down over 4 million barrels. Gasoline down over 3 million barrels. This is saying that, hey, look, there's a whole bunch of demand going on because people are out driving, flying, doing things, and that's a good thing for the economy. Bad for inflation, suggesting inflation could go higher. But what happened here is crude oil inventories rose almost 3 million barrels. And if you're following crude oil's trading today, what you notably saw is crude oil prices went down. So even though we saw these big product draws, the crude oil market is not buying it. They're not believing that this is actually a big move higher in demand, that perhaps it's just some transitory data coming out of the holiday weeks that we just saw. And something else that doesn't make sense is, despite all the chatter about refilling this from a zero hedge, the Biden administration drained almost 3 million barrels from the SPR, which would show, when you add that back in, what we actually saw was quite a big actual build in crude oil. The question is, when are we going to stop draining the Strategic Petroleum Reserve? There's a reason. It's called strategic because we need it in case something goes wrong. If anything goes wrong in the global economy, we're just not in a position to handle it. But will it bring inflation down? Well, it doesn't appear to be making a big mark, as we know the administration was hoping, but that hasn't caused them to stop, even though prices now are at a point where we could be starting to refill it. But now let's get into our headline story, because is this coming crisis about to start? Are we weeks away? And is it going to be far worse than most people think? Well, let's see what this one expert says. Drunkenmiller says the U.S. is on the brink of a recession, sees a hard landing. The billionaire cites the regional banking turmoil, predicts the unbelievable opportunities. We'll talk about that in a moment. And of course, because what we can note here is we've been making the case for a hard landing, but at the same time, hard landings create unbelievable opportunities. And one place you'll see that is in our CTA-Timer Pro report. We've been telling you, people have talked about how they keep buying high and selling low. If they could just get that flipped upside down, what this report does is it shows you the machine positioning. So here, look at this, the Nikkei 225, very long. You wouldn't want to be trading this probably right now. What you want to do is find out when this is minus 100, because what it does is historical overlay. It goes back throughout history, looks at the current positioning, makes an adjustment. When you see these things at extreme minus levels, run your own data over it, and then put your trades in. So many of the people subscribing have said, Steve, this has changed the way I've traded. It's making me much more confident. It's helping me find the ones that are low, and the success right now when I trade is so much higher thanks to your report. $30, going to 40 soon, so get it while you can. I'm not predicting something worse than 2008, Drunkenmiller said, but worse yet, he says you've got to be a good risk manager. It's just naive not to be open-minded to something really, really bad happening. And of course, we know that something's bad is going to happen because if you study monetary policy throughout history, what you find is that when you have a large influx of money come into an economy that drives asset prices up, and then for some reason, maybe it's just a withdrawal of that stimulus, of that money, or maybe a slowdown of that creation, at some point the engine flips over and what you see is the economy turns down and asset prices start to fall. The fact that we're seeing even any banks fail at this point tells us there's something seriously wrong. We know the money supply is contracting. We know there are huge deflationary forces under the money system going on here, which is suggesting when you take in everything in account, the withdrawal of the stimulus, high inflation, we know periods of high inflation lead to recession. We see all these pumped up asset prices, that something bad is coming. We're going to see a financial crisis, a credit crisis, an unemployment crisis. It's all coming to a head because nothing here is safe. And he's defined a hard landing as unemployment exceeding 5%, corporate profits slumping at least 20%, and rising bankruptcies. Of course, we've already made the case that bankruptcies are going to head a lot higher because when unemployment rises, well, people just aren't going to be able to make payments on those loans. And we're already seeing the early signs of that. Of course, we'll have more data on that tomorrow. But let's first take a look at the unemployment rate. And Drunkenmiller says it has to hit 5%, which that's here in the green line. So if the blue line gets up there, and you can see that in past times when the red line, which is a 4-week moving average of initial claims, start to shoot higher, well, that unemployment rate could really rise. So getting to 5% at this point seems like something that's very, very achievable if we have a recession, let alone a financial crisis. But one thing I think he's wrong about, he's saying at least a move down in corporate profits to 20%. Well, that would put us here about the yellow line. And what's notable is pre-pandemic, corporate profits were kind of just, stagnating here. The idea that the economy can hold up and corporate profits can stay that elevated, I just don't buy it that it could happen at all. He thinks it could. My case is when you see a massive amount of unemployment, when you have huge inventory builds, what you're going to see is companies having to slash prices, take losses, clear that inventory, and profits are going to come crumbling down. The downturn will occur at some point during the current quarter, putting us weeks away from this beginning, even earlier than he previously expected. And he's notably, there's a decline in a number of factors, a decline in retail sales, and the upheaval of gripping the nation's regional banks that's prompted him to accelerate his forecast. Well, all he had to do was look at that SLOOS report, that Senior Loan Officer Opinion Survey, and just see how banks are tightening standards to know that the probabilities of a hard landing and a financial crisis are high, one that I think, and I'd love to know what you think, could rival the global financial crisis. And you're going to have unbelievable opportunities in the next couple of years. There's a lot of dispersion within the industries. He said, just make sure you preserve your capital until they present themselves. That's always the key, because now Wall Street leaders are warning the unthinkable fallout if the U.S. defaults. Look at this. The short-term impacts of protracted negotiation are costly. The long-term implications of a default are unthinkable, the leaders are saying. The magnitude of adverse consequences from a prolonged negotiation or default is unquantifiable, using some very big words here to say that, look, we can't let this happen. We're going to make the case of which side may have the power behind them here in a moment. Let's look further. There's risk to the dollar. Well, there's risk to everything if this thing fails, but we have a recent poll now from ABC. This has brought doubts about Biden's age and acuity spell Republican opportunity in 2024. Well, perhaps the opportunity is right now with the negotiations, as President Joe Biden's job approval ratings, whether you agree with this poll or not, have hit a career low in the latest ABC News Washington Post poll. And abroad, 68% of Americans say he's too old, and views put him in a trailing position against top Republicans. Forget that for the moment. How about in the negotiations? Because right now the good news is they had their first meeting, but you think about how negotiations go when one side realizes they have the power, because if the popularity of the other side is declining, well, that means that their agenda is likely not going to get pushed through. They're going to have to back off a little bit to try to keep in power. Because remember, the first goal of every politician is to get elected. Remember the second goal? Right. get reelected. So sometimes you have to make some changes. And so far, Biden, McCarthy vowed more debt limit talks as default looms. And over the last few days and weeks, there's going to be a lot of posturing, politics, and gamesmanship. It's going to continue for a while. Of course, we know the president said he viewed the conversation as productive. Of course it is, because we don't want to give any hint to the bond market or the press that perhaps this could lead to a default. Not to worry. At the final hour, if it goes down to it, there will be some sort of extension. But right now, if you look at just the polls, perhaps McCarthy's got a little bit of edge. The question is, can he get a little bit of what he wants? We'll soon find out. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.